India's overnight liquidity shift, the call money market surge, and its structural implications. How extended trading hours and surplus liquidity reconfigured interbank dynamics. In the architecture of a modern financial system, the call money market functioned as the most transient of all interbank conduits, an ephemeral channel where funds are borrowed and lent overnight with negligible terms and near zero credit risks. Traditionally, in India's money market ecosystem, the share of call money volumes has inhabited a narrow band roughly between 2 and 2.5% of total money market turnover. This limited shares is not an account or an accident, but a structural outcome of liquidity distribution, demand composition, incentive alignment, and cross-market participants. When market share swiftly breaches established thresholds, in this case rising above 3%, it is not merely a statistical upstick, but a symbol of deeper force at work within the financial system. The Reserve Bank of India's decision, effective from July the 1st, to extend trading hours for call money, repo, and tri-party repo (TREPs) markets until 7 p.m. was a policy lever that recalibrated the overnight operational horizon of interbank activity. This extension is not a cosmetic adjustment, it redefines the temporal frontier at which banks can deploy excess funds, shifting the equilibrium between idle liquidity and productive allocation. The extension increases the effective trading window, compressing the opportunity cost of holding surplus cash and raising the marginal utility of short-term deployment. In an environment already saturated with liquidity, this change shows how procedural adjustments by a central bank can reshape behavioral incentives across different market sectors. Liquidity in the banking system is presently in a pronounced surplus. This is not a transitory phenomenon, but an entrenched condition driven by broad macro-prudential flows, weak credit demand, and structural accumulation of reserves. When banks hold cash beyond their immediate funding requirements, the incentive structure for deployment must navigate between risk containment and return optimization. Longer trading windows reduce the temporal friction of overnight deployment, enabling institutions to engage directly in short-term interbank lending rather than defaulting to central bank accommodation or passive holding. This surge in call money share is an express reflection of this shift. Banks with surplus are choosing the call money segment with increased frequency not because it is now economically rational to do so. The volume increase in call market activity therefore is not an artifact of market stress or a signal of tightening liquidity crisis. On the contrary, it is an emblematic of systemic liquidity abundance. In conventional financial analysis, a high call money share might be misinterpreted as a sign of interbank credit strain. If funds were scarce, banks would be compelled to borrow more aggressively. However, the data here indicate quite the opposite. Institutions possess more funds than they can deploy through traditional long-term institutions and instruments or through credit channels. Hence, their migration towards the call money markets as a low risk, low return, but not temporarily extended option. Critically, the behavior response of banks to these conditions reveal a deeper truth about financial incentives. Even when returns are muted, the mere opening of additional trading hours can act as a catalyst for incremental deployment. This suggestion that market participants are actually sensitive to changes in structural opportunity sets not solely to yield differentials. If the operational window had remained constrained, the surplus cash would largely have remained parked in a non-productive modalities. By extending the clock, the RBI has effectively pulled forward the utilization of idle funds, forcing a reallocation decision that banks would consider defer or avoid. Examining the mechanics of this shift exposes how liquidity pulses course through the interbank network. Banks that hold excess reserves now find it slightly more attractive to engage in the call money market because the cost of capital remains negligible and the extended trading horizon allows them to capture even marginal returns while maintaining flexibility. Conversely, banks that require short-term funds can also access the risk of end-to-end funding shocks. The result is a subtle but meaningful compression of risk in the interbank space. For a systematic perspective, this recalibration has mixed implications. On one hand, a surplus-dominated environment reduces the likelihood of distress-driven liquidity squeezes. Banks are able to finance themselves cheaply and with minimal friction. On the other hand, when liquidity is abundant, price signals become muted and discipline of opti- scarce capital diminishes. Markets risk become complacent, valuing convenience over economic rigor. The extended hours may inadvertently institutionalize a higher tolerance for idle liquidity, weakening the systematic imperatives to allocate capital towards productive investments or credit expansion. However, the structural bias towards surplus accommodation places a premium on central bank operational choices as primary driver of interbank behavior. In other words, the market response is not fundamentally organic, but conditioned by the incentive established through regulatory and procedural design. This undermines the notion of a self-correcting market mechanism in favor of a system where policy nuances dictates market flows. The consequence is that highly systemic liquidity management becomes less about market forces and more about central bank calibration. Explicit extension of trading hours being a prime example. If the behavior remains static, several outcomes are foreseeable. Banks will continue to treat the call money market as a default repository for surplus funds, reducing the urgency to innovate in other short-term investment channels. The longer trading window may become a structural expectation, not an exception, resetting the benchmark for overnight intrabank engagement. Repo and TREPs segments might see relative declines in activity as participants gravitate towards the call money segment due to an ease of access and minimalized operational constraints. In aggregate, the money market could ossify around a new normal where money consistently represents a higher share of total turnover, not because of market driven demand or supply demand dynamics, but because of institutional inertia shaped by the extended hours regime. In conclusion, the recent increase in call money share above 3% is not an isolated statistical fluctuation. It is the product of a calibrated policy shift intersecting with systematic liquidity surpluses, yielding a configuration of intra-bank dynamics. The underlying forces are not symptomatic of stress but of abundance. Banks are leveraging the marginal increase in operational hours to deploy funds that would otherwise remain idle. This shift underscores the power of policy design in shaping financial behavior and highlights the complexity of interpreting market indicators outside of their broader structural context. The long-term trajectory of this behavior will depend on how liquidity conditions evolve and whether banks find alternative, more productive channels for surplus deployment. Absent changes to these core drivers, and the extended call money market regime is likely to persist not as an anomaly, but as a new baseline in India's overnight funding landscape.